What if I told you the biggest threat to the U.S. economy isn't a recession? It's what happens after people run out of options. For months, consumer spending has held up better than many economists expected. But beneath the surface, a different story has been unfolding. Many households have relied on savings built up during the pandemic, increasing credit card balances, and other financial cushions to keep spending. The question is, what happens when the cushions disappear? Today, we're looking at why some business leaders are becoming more cautious, what the data is saying about the American consumer, and the question policymakers may have soon to confront. Welcome back to the channel. If you're here, we break down the biggest shifts in money, markets, crypto, and the future of finance so you understand where capital is moving before it becomes obvious. Let's get into it. Broken yet on the surface, things still seem fairly stable. Many people still have jobs. Stock indexes have remained resilient. Corporate earnings in some sectors continue to surprise analysts. But economies don't usually change overnight. They weaken gradually beneath the headlines. Many companies have started talking about slower consumer demand, rising costs, and greater uncertainties during earnings calls. That doesn't mean automatically a recession is around the corner, but it does suggest many executives are preparing for a more challenging environment. Consumer spending has been one of the biggest reasons the economy has continued to grow. But consumers aren't an unlimited source of demand. Many families are dealing with higher credit card balances, elevated interest rates, higher insurance costs, rising housing expenses, increased everyday living costs. The longer these pressures continue, the harder they become to absorb. Why August matters? Some analysts are watching the late summer closely because seasonal spending, back to school expenses, household budgets often collide around that time. For many families, that's when the financial stress becomes more visible. That doesn't guarantee an economic turning point in August, but it does make it an important period to watch. Markets often respond not just to economic conditions, but to changing expectations. Corporate leaders don't wait for newspaper headlines. They monitor consumer demand, hiring trends, inventory levels, profit margins, capital spending. When enough companies begin slow hiring or delaying investments, it becomes a signal that executives expect more uncertainty ahead. That's why investors pay close attention to what CEOs say and not just what economists forecast. The question nobody wants to ask: what happens if consumer spending slows significantly while government debt continues to rise? Can the economy continue growing under these conditions? Will low interest rates be enough to stimulate demand? Or are we entering a period where productivity, technology, and artificial intelligence reshape the economy faster than the traditional policy can respond? These aren't easy questions, but they're becoming increasingly important. What this means for investors: periods of uncertainty can create both risks and opportunities. Some investors focus on defensive assets. Others look for sectors benefiting from long-term structural changes, such as artificial intelligence, blockchain infrastructure, digital payments, or cybersecurity. The key isn't reacting emotionally, it's understanding where capital is moving and why. These are my final thoughts. Whether the economy slows sharply, continues to expand, or settles somewhere in between, one thing is clear: the financial system is changing. Understanding those changes may matter more than trying to predict the next headline. If you want a weekly research on macro trends, crypto, stable coins, tokenizations, and where smart money appears to be moving, subscribe to the Human Capital newsletter below. Thanks for watching. I'll see you the next video.